Hello Deep Value community, welcome back. Today I want to talk about circular competence. In this video we're going to talk about developing your investment temperament, what you should look for in a business, what you should avoid. But before we get started, if this is your first time here, please subscribe because this is our value investing journey. So let's get started. So both Warren Buffett and Charlie Munger talk about the investor not needing a high IQ to get extraordinary returns. The investor just needs to develop the correct investment temperament. You may be born with this temperament, you may not. But like any skill, it is important to keep developing over time. The best way to develop this skill over time is through hard work. Hard work is studying businesses, studying mentors, both living and dead, how certain mentors overcome certain problems, trying to understand different business models, building a framework of many different businesses. You will see over time that there are not that many different business models, and trying to understand how they compare and contrast against each other. Which one is a better business model? So that's the first thing that I would work on. The next thing is to be unemotional when investing. One trick that I found is always talk about your investment failures. Do not talk about the times that you have succeeded. The reason is twofold. If you talk about your successes, you're more likely to be entrenching yourself. The business may have lost its margin of safety. The share price may have appreciated, but because you feel so passionate, so emotional, so content with that business, you believe that it was going to keep appreciating over time. However the business has performed over the past, say, 5 years, it is not representative of how it's going to perform over the next 5. The next advantage of talking about your investment failures is that it sizzles them in your mind. Every time you speak to that person that you're describing investment failure, they're going to remind you that failure. And the more you keep at the forefront of your mind your investment failures, the less likely you are to repeat that exactly same mistake. You will repeat a different version of that mistake, but hopefully when that happens in the next time, you'll be quicker to recognize the failure and you'll be able to exit that position much quicker. Now, before we move on to the next one, the most important aspect of what to look for in an investment is buying an investment, buying a business as you would buy a house. Do not speculate. Whenever you buy a house, you go through quite a lot of due diligence. You spend quite a while thinking about that house. You compare that price of that house to its neighboring houses. What would your business be worth in 2-3 years? So think about how much capital you would take to buy up the whole business and what that capital that you're deploying could buy in a different business. So follow that business over the course of 3-4 quarters. Look back over the transcripts. Look back. This is what they were saying 3-4 quarters ago, and this is how the narrative has changed over time. It is a bit of hard work going through all these transcripts, but the more you do it, the more you kind of able to refine what to look for. You kind of pick up straight away, okay, this is really what's critical about this business. And you can superimpose that data that you're collecting for business X, Y, and Z to business 1, 2, 3 if it's a peer. So you can, the more you understand the landscape, the more you understand the peers, the more of a history you've got of looking at the transcripts, the earnings call, the more you're able to understand, okay, like what I was thinking before I invested and what I'm actually investing in might not be the same thing. Next, you need to, when you invest, it's about attempting to put the odds in your favor. Do not invest in businesses that are unstable. By unstable, I mean businesses that have 2 or 3 years of earnings and then they have a huge loss. 2 or 3 years of earning and then have a huge loss. Also, a quick check. Make sure the business is actually making free cash flow. Make sure that the business is self-funding its revenue growth by actually monetizable revenue, not just revenue for the sake of revenue and then needing to seek out capital markets, diluting the shareholder over time. So if you found that video useful, please subscribe, because it's a high value investing journey. See you next time.